And he is also the president of the rail leasing unit. You have the biography and the announcement, so I don't want to spend time there. I want to give as much of a time as we can to Paul. So thank you for coming, Paul.
All right. Well, thank you, Norm. Hopefully everyone can hear me. I've got the mic going here. And we'll get right to it. First of all, I just want to thank the Transportation Center for having me. It's really a delight to come and talk to all of you. You know, when I do a lot of public speaking on behalf of GATX, but usually it is shorter form and very targeted for some business purpose. And here I get to spend a little bit of time waxing historical about the industry. And those who know me know that I describe myself as a rolling stock nerd. So I get a chance to actually really embrace my rolling stock nerdiness here and tell you a little bit more in more detail about the business that I love and that I've been doing for the last 27 years. So with that, we'll jump right in, assuming the clicker is doing what it should. Is it? It is not. At least it's the right, is it the right-hand button I should be using, or?
Yeah, it was working before.
Yeah,
let's just click this. Now it is.
Oh, okay, there we go. Perfect, fantastic. Okay. All right, the lawyers make me put this up. None of you will read it, but pretend you did. All right, so what I thought I would do, if you've heard me speak publicly in the past, and a number of you in the room have, Harry has probably heard me, I don't know, 100 times at this point. What I generally do is talk about the railcar market in North America, and I'm going to do that today. So really, in a way, items 1, 3, 4, and 5 are a version of what I usually talk about. Item 2 is the unique bit for this discussion, and we're going to get a chance, as I said, to go a little deep into how we got here in terms of the North American rolling stock market. And as I said, I'm very excited for the overall talk. I'm particularly excited to get into item 2 a little bit here. So briefly, we'll talk about the railcar market. So one of the things I think that surprises people who aren't experts in rail is that the railroads don't own most of the rail cars in North America. You can see here, railroads today own about 15% of all the rail cars in North America. That has declined. We sort of, as an arbitrary point, picked 2008, which was the beginning of the Great Recession, as the measuring stick to describe these changes in ownership here. So you can see over the 16 years since then, the railroads have actually seen their share of ownership of rolling stock cut almost in half. Lessors like GATX and our competitors, we've seen a substantial increase in our ownership of rolling stock. Rail shippers, so those are your Cargills or ADMs of the world in the ag world, or the electric utilities or the petrochemical companies, have seen a little bit of a decline in ownership. And then TTX, which is the railroad-owned pool, has been roughly stable, a slight increase. Why, you may ask, is this happening? Well, I'm going to get into the history of it all, and there's a lot of history to this, but what I will say is, one thing to remember is that rail cars are capital intensive, they are maintenance intensive, and they are complex. And lessors like us specialize in tackling those challenges. And that's really why we've seen the growth in lessor ownership of rail cars. But again, we're going to get into that in a lot more detail coming up over the coming slides. So thinking about who owns what rail cars, we can break rail cars down into specific car types, which we do on the left here. And then we can also talk about just tank versus non-tank, or tank versus freight on the right. So on the left-hand side, you can see almost 80% of all of the rail cars in North America are either covered hoppers, tanks, or open tops. And what that tells you is the North American rail market is really a bulk-focused rail market. So box cars, intermodal, flat cars are the distinct minority of the fleet. Now, it's a little bit unfair to intermodal because intermodal cars turn so often that you can get a lot more freight moved with a smaller number of cars. But even adjusting for that, what this pie chart tells you is that the North American freight rail network is bulk focused. On the right, this kind of underscores what I was talking about the benefit that lessors confer. Tank cars are the most complex assets to own from a maintenance and regulatory compliance standpoint. And as a result of that, operating lessors really dominate the tank car landscape because operating lessors specialize in having that expertise and capability to deal with that complexity. But even freight cars at the bottom there, you can see there's a lot more participation from railroads and shippers as well as TTX. But even freight cars, you can see lessors by far have the largest share of ownership. So what exactly does an operating lessor like GATX do? Well, it's deceptively simple. We buy rail cars, and rail cars last a very long time. The regulatory life of a rail car in North America today from date built is 50 years. We lease those rail cars typically for a much shorter period than the useful life of the asset. So one of the most important things that a lessor does is it takes remarketing risk. So if you are a rail shipper, you may not be able to predict your demand for a rail car for more than a year or two. If you're putting the capital in to buy a 50-year asset, there's a real mismatch there. So that's one of the key pieces of value that a lessor does is we take that risk. We take the risk of that mismatch between foreseeable demand and asset life. Operating lessors also maintain rail cars. And here I'll get into some distinctions. There are some what we call integrated operating lessors. GATX is one such lessor where we actually own our own repair shops. So the business that I run has over 1,000 people that do nothing other than repair rail cars all day. And that's spread across 7 locations throughout North America. But there are other operating lessors, a lot of which are units of financial institutions that don't own repair shops. And in some cases, if they're owned by a bank, may be prohibited from owning repair shops. They outsource their repair activity to what we call merchant repair shops. And so there's a large network of repair shops throughout North America that maintain rail cars, and they are really separated into lessor-owned and merchant. And then finally, at the end of a rail car's life, or maybe not at the end of a rail car's life, operating lessors dispose of rail cars. And I say maybe not at the end because there is a very liquid secondary market for the buying and selling of rail cars that may have useful life remaining. All right, so why would you lease a rail car? This gets to some of the themes I was talking about. Well, the first thing is a lot of our customers simply want to be capital efficient. They would rather have rail cars sit on our balance sheet than sit on their balance sheet. But also, as I mentioned, there's a lot of expertise involved in owning and managing and maintaining and remarketing a rail car. That is not the core competency of, say, a grain company. So if you're a grain company, even if you got a big balance sheet and don't mind consuming capital by buying rail cars, you just don't have the expertise necessarily to run that fleet. I talked earlier about fixing the mismatch between the life of the asset and foreseeable business need. I also talked about complexity, because again, there's a lot of complexity, particularly with tank cars and other specialty rail cars where there may be regulatory compliance or product purity or corrosion concerns where the maintenance regime is quite complex. And then finally, and this is really, I think, one of the key things about operating leasing, to transfer risk. If you really want to think about the business of operating leasing, it's a business in which a lessee transfers various types of risk: maintenance risk, regulatory compliance risk, obsolescence risk, remarketing risk, et cetera, et cetera, et cetera, transfers that risk to the lessor. And so as a lessor, we get paid to, within reason and within certain parameters defined by our lease agreement, assume some of that risk. So I mentioned GATX and our competitors. There are many competitors. I would say that in contrast to other aspects of the rail industry in North America, operating leasing is a very, very competitive industry. There are 6 large operating lessors, and I define large as having at least 100,000 cars in the fleet. But there are a wide range of other operating lessors with a wide range of sizes, ranging from upwards of 50 or 60,000 rail cars all the way down to very small fleets where it might be a few hundred rail cars. I will say it's a scale business. If you're going to try to compete at a small scale, you have to have some competitive advantage, knowledge, customer relationship, local presence that allows you to compete at a small scale. Otherwise, I would say I feel, frankly, very fortunate to work at a very large-scale operating lessor because it allows us to deploy the resources we need to run the business in the right way and spread the cost of those resources, which are quite substantial, over a very large asset base. Okay, so now we get to indulge my nerdiness here and go into a little bit of the history. So I'm going to start back in the 19th century, because if you're going to talk about railroad history, you have to start when the railroads came to the United States and came to North America. And so I think it's important to remember that in the beginning, for the most part, railroads emerged as these privately owned transportation companies where the rolling stock, the right-of-way, the fixed plant are all owned by the same company. So there's no such thing as GATX. You know, if you're dealing with the Delaware and Hudson Railway, to pick one of the very early railways in North America, the Delaware and Hudson had the crew, the locomotive, the rail car, the track. They were the soup to nuts transportation provider. After the Civil War, we see this dramatic expansion of rail as the United States industrializes, and we start to see the initial emergence of private car companies like GATX. And what we find there is there are niches that are not being filled by the railroads, and specifically this relates to specialty cars. And the early specialty cars that are owned by private car companies are tank cars and refrigerated box cars. These are cars that are complex, difficult to maintain, commodity specific, typically empty return type cars where the railroad doesn't have the expertise and doesn't want the expertise. So that's the beginning, that's the origins of companies like us. And so in that latter part of the 19th century, we see the foundation of Union Tank Car, American Car and Foundry, GATX, and others. And that becomes a blueprint for the way the industry is going to work for quite some time. Having said that, non-specialty cars, so general purpose freight cars, remain 100% railroad owned. Again, railroads are rich at this point. They have tons of capital to invest, and they see themselves as efficient fleet owners and fleet managers for these general purpose freight cars. And modern bulk rail cars haven't been invented yet. So if you're moving a bulk commodity right now, you're moving it in a boxcar. And some of you may not know this, even things like bulk grain were actually loaded bulk into a boxcar. I won't spend a lot of time on this, but there was actually a device called a grain door that allowed you to load grain in bulk into a boxcar. It was ridiculous, and it was definitely not an efficient way to move bulk commodities, but before the invention of the gravity-covered hopper, that was how grain moved. All right, so now we advance a bit into the 20th century. Well, we'll start in the late 19th. So everyone's familiar with the ICC. The ICC brought economic regulation to the railroads, and at the time, of course, it was the era of the robber barons, and this was sorely needed. And it codifies a number of things about how the railroads operate. Following that, you have the two world wars, and the two world wars identify for the country just how essential the railroads are to the country's success and well-being. But at the same time, by the end of World War II, the railroads are just exhausted. They have spent a tremendous amount of money and resource running to serve the nation, and they are depleted. At the same time, beginning in the 20s, the government begins to invest in a national network of highways. First, the US highway system, and then eventually in the 1950s, the interstate highway system. So you start to see the seeds of problems coming for the industry. But the rolling stock environment here hasn't really changed. You still have the traditional private car companies, and you still have the railroads controlling most of the general purpose freight car fleet. That has not really changed since the 19th century, despite all of the changes I'm describing here. So now we fast forward to the post-war era, and we're starting to see the financial toll that the developments I described earlier are taking on the railroads. Highways are expanding, the railroads are losing traffic, the railroads are consolidating, there is some shrinkage, and even with the consolidation and shrinkage, the railroads are not earning their cost of capital. But we do see some technological improvements that are starting to drive efficiency. In the late 1950s, we had modern roller bearings emerge. So you had the first 30-ton axle loading cars, what we think of as the 263 gross railload standard. So you start to see some new bulk rail car designs that take advantage of these heavy axle loadings. So that's when you start to see the first modern grain hoppers. Some of you may know the term the Big John grain hopper, which is one of the early designs. You start to see pressure differential hoppers for powdered commodities like flour. And you start to see the first high-capacity coal hoppers and gondolas, and that leads to the introduction of the unit train, which was a concept that really had not been used until the post-war era, of a single commodity moving from a single origin to a single destination in train load form. Now, to be clear, coal from the mine to the port had sort of always moved by default as a unit train, but these were the first shipper-specific dedicated unit trains. And what we see with that is, because the railroads are starting to have real capital constraints, a lot of these new railcar types, they're not owned by the railroads. We start to see shippers and operating lessors investing in some of these new technology cars and supplementing, and as I note here, supplanting in some cases, railroad investment in these assets. You also see a different solution created. The railroads create a railroad-owned pooling company, now known as TTX, then known as Trailer Train, as a different source of capital to invest in intermodal cars for the fledgling trailer on flat car market. So you see a number of different approaches being employed to deal with the fact that the railroads themselves are starting to get capital constrained and less able to invest in rolling stock. So now we get into the 1970s, and we are in full-on malaise. That was a Carter term for those of you too young to remember the 1970s. But Jimmy Carter talked about the malaise that America was facing. By the way, great president, very underrated. But in any event, the 1970s were a real problem for the rail industry. We start to see significant bankruptcies across the Northeast and even outside the Northeast. And we begin to see rolling stock crises. And these crises are going to give rise to what ultimately shapes the modern rolling stock market. The first big crisis we see is the boxcar crisis. There's been underinvestment, under reinvestment in boxcars. And there are a couple of solutions that get implemented to try to solve this. So for the first solution is the Interstate Commerce Commission creates a system of incentive car hire. Basically, car hire are the hourly and mileage charges that accrue to a car owner when it runs on a railroad that is not the car owner. The ICC creates an incentive system of car hire to allow investors to invest in short-line boxcars and to create a revenue stream to pay back those investors. So that's the private market system that is created to incentivize boxcar investment. At the other end of the spectrum, we see TTX, who I referred to earlier, which was created in the 1950s to run the intermodal pool. TTX now enters the boxcar market and creates the Railbox boxcar pool. So those are two different solutions to the boxcar crisis. And we do see that they collectively work to foster a boom in boxcar production. A fact which we're living with right now, which has created some interesting unintended consequences 50 years after the fact. Harry is smiling over there because he and I are trying to deal with this crisis as we speak. We also see in the 1970s the emergence of captive builder lessors. So what do I mean by that? Well, in a world in which the railroads are capital starved and are not investing, the rail car builders need a vehicle to be able to support consistent production. So by opening up captive leasing companies, a captive is a leasing company owned by a car builder, they create a pipeline through which they can produce new cars and put them into the market without necessarily closing a sale to a railroad. And this becomes a bigger and bigger phenomenon over the coming decades. All right, so now we get into the 1980s. So I mentioned the ICC in 1887. So in 1980, the Staggers Act undoes all of that and deregulates the industry. I have a lot of opinions on the Staggers Act. I'm not going to bore you with them right now because that's not why we're here to talk. The relevant fact about the Staggers Act with respect to the rolling stock market is economic deregulation of the railroads has a profound and mostly negative effect on boxcar traffic. There's a tremendous amount of boxcar traffic that was moving until deregulation that is no longer economical for the railroads to move in the deregulated era. So boxcars are rendered surplus. And importantly, we had right leading up to deregulation, a huge boom, not just in the build of boxcars, but in the building of all types of rail cars. The period 1975 to 1981 was one of the most robust and prolific periods of rail car construction in American history. So all of a sudden now, on the heels of that boom in railcar production, you have deregulation that has eliminated a lot of traffic. You have an absolute collapse of the car building universe. In the years following 1980, 2/3 of railcar builders closed their doors permanently. My own employer, GATX, we actually had a railcar manufacturing operation in Sharon, Pennsylvania. It was small and it existed really only to feed our tank car leasing business. We closed that business in 1984 because there was no ability to economically sustain that business. And there basically is a lost decade following deregulation during which very few rail cars are produced. The pain that the car builders suffered was acute, and we ended up coming out of the 1980s with only 7 car builders left. As I mentioned, because of the loss of boxcar traffic, the so-called per diem lessors, those are the 1970s era lessors that had invested in boxcars to take advantage of the ICC's incentive per diem rules, they suffered the most. But you begin to see out of the ashes of that, a new trend exists. We see financial institutions, and GE Capital was the first big one to do this, enter the leasing market. GE bought North American Car Corporation, which is one of those lessors that was suffering in the post-deregulation era. And put a pin in that because we're going to see as the operating lessor landscape develops, this is a major phenomenon that we have to keep track of. I want to take a look at the time real quick too, because I have a tendency to overstay my welcome if I'm not careful, but I think we're doing okay here on time. So a lot of people have talked about the railroad renaissance. I think my friend Tony Hatch actually was the one who coined the term the railroad renaissance, if I'm not mistaken. But I actually thought Tony was going to be here tonight, but maybe he's online. But in any event, the railroad renaissance refers to the period when the dividends of deregulation start to be harvested by the Class I railroads. It's when the rationalization that occurred from 1980 to 1990 finally produces a balance between demand to move rail freight and capacity to move rail freight. And that allows the railroads to start to price traffic in an economically remunerative way, and allows them to begin to reinvest and to actually perish the thought, try to grow traffic. The implications on the operating lessor universe of this are very significant, because now we finally, for the first time since about 1981, we see real demand for rail cars. And so I mentioned GE entering as the first financial institution entering the lessor market in the 1980s. Now you see a number of financial institutions start to enter the rail car market. You also see operating lessors of all stripes, whether traditional lessors like GATX or financial institutions like GE Capital, begin to broaden their car type footprint. So in other words, the railroads, as the railroad renaissance takes hold, the railroads are looking to operating lessors for the first time to invest in large numbers of general purpose freight cars. So grain cars, mill gondolas, coal cars, et cetera, et cetera. You also have something happen here. I mentioned car hire before, and I mentioned the ICC-driven incentives in the car hire market to drive boxcar production. Well, the ICC decides in 1993 that that was a mistake, and that they were actually over-incentivizing boxcar production. Again, we can debate that. I'm not going to do that here. And as a result, the ICC does something called deprescribing car hire, and that fundamentally changes the boxcar market again in ways that, again, we're still grappling with today. So from the railroad renaissance, there's a brief blip around the 9/11 recession, but coming out of the 9/11 recession, we see this incredible period of what I call commodity-driven boom and bust. So in the early 2000s, we have a boom in Western coal shipments and investment in high-capacity aluminum coal cars to move coal. You see a boom in lumber as the housing market takes off. For all of us who lived through the Bush administration, the ownership society, and the housing boom and ultimate bust that occurred. We see the beginning of the ethanol market there. We see subsidies to produce corn-based ethanol and a huge demand for ethanol tank cars. This leads a huge boom in railcar production from around 2002 through around 2006, 2007. We then have the Great Recession, and there's a collapse in demand for railcars and a collapse in production. But that lasts only briefly, and then coming out of the Great Recession, we see a boom in frac sand and a boom in crude oil by rail. And so we see another rail car cycle that ramps up. This is a very difficult time for the car builders because we have years where production is less than 20,000 cars. Afternoon, Marty. Quite all right. So it's the retired chairman's prerogative to be late. But the so we go from annual production of less than 20,000 rail cars as an industry to over 80 and back down to less than 20. It's a difficult time to be a car builder, and it's a difficult time to be a lessor because although we are not quite as subject to the shocks of demand the way a car builder is, the lease pricing and fleet utilization that we experience yo-yos dramatically as we see these booms and busts. We also see a lot of operating lessors doing what I call chasing shiny objects. And what that means, for example, is if there is a demand for, say, ethanol cars, a prudent lessor might say, my overall market share is 5%. I don't want to be overweight ethanol. I don't want my share of the ethanol market to be more than 5% because I'm going to potentially get overweight a commodity that could later crater. A lot of operating lessors, particularly many of whom have management that is incentivized on volume, bad idea, by the way, overinvest in a lot of these hot car types and pay an enormous price when those bubbles burst. And we saw that with ethanol, we saw that with lumber, we saw that with frac sand, we saw that with crude by rail. It's a tremendous challenge, and this is not to denigrate those folks. Fundamentally, it is a hard business to be in, and there is a tremendous temptation to chase the demand that the market throws at you. But obviously, it leaves you very vulnerable. And so that was a tremendous challenge for both the car builder and operating lessor market. In addition to that, you had these macroeconomic shocks, whether it was the Great Recession, whether it was the wildly fluctuating price of crude oil. That also took a toll by enhancing the volatility of the market. And then finally, we begin to see the emergence of cheap liquidity. Now, cheap liquidity during this era was not as ridiculously cheap as liquidity got in the subsequent COVID era, but it was still cheap relative to historical standards. And one of the things we find in the railcar market is a lot of investors who may not know rail very well, but who have money burning a hole in their pocket, will look at rail cars and say the cash on cash yield of a leased rail car is really good. I don't need to worry about the complexity, and we'll pile money into the market, and then we'll later figure out that, oh, I probably did need to worry about the complexity. But by that point, it's too late. So this is all to say this period from 2002 to 2015 was a wildly volatile period in the railcar leasing business. We also, I don't want to lose sight of item number 5, particularly with the retired chairman's emergence here into the room. This is the beginning of so-called precision scheduled railroading emerging. And that is, to be clear, a railroad issue, not a car owner issue, but it is a car owner issue in the sense that it dramatically affects the demand for rail cars in a variety of different ways. And so ultimately, put a pin in that as well. We're going to come back to it because PSR, as it really takes hold, has profound impacts on car owners. Okay, I described the next 4 years as the hangover years. Why do I call it the hangover years? Because the crude by rail boom was the party of all parties in the rail car market. I talked about how production of new rail cars yo-yoed from under 20,000 cars a year to over 80,000 cars a year. At the peak of the crude by rail boom, the backlog of ordered but unbuilt rail cars was equal to approximately 2 years of production. It peaked at over 145,000 rail cars. That is an enormous backlog. We've never seen a backlog like that. And one of the things about a market like that is you should always be suspicious when things are dramatically different in a very extreme way, and yet the fundamentals don't necessarily point you in the direction of that extreme. So what do I mean by that? Well, essentially, crude by rail had emerged thanks to a variety of different macro phenomena, including the global price of oil rising, fracking becoming economical, and a restriction on the construction of new pipelines in the United States. So we had this very short-term phenomenon of crude oil moving in unit trains, principally out of the Bakken Shale, but also out of other areas to various destinations around North America. It was very tempting for investors in rail cars to chase that particular shiny object, and many investors in rail cars chased it really hard. I'm proud to say at GATX, we hired some really smart people who knew the crude oil market, who explained to us the short-term and long-term economics of crude oil by rail and said, don't go long. And we didn't. That was much to our benefit because the bubble popped, and when it popped really hard. And there was a tremendous oversupply of a wide range of rail cars, not just crude cars, because one of the things we saw when the new car production backlog got pushed out due to frac sand hoppers and crude oil tank cars, it also caused over-ordering of a variety of other cars because you couldn't get your boxcar or your mill gondola or your flat car or your intermodal car for 2 years. And so there was double and triple ordering relative to demand of those cars as well. So the hangover from the crude boom wasn't just a crude hangover, it was a railcar market hangover. We also have here the beginning of what I call the metastasis of PSR, which should give you a sense of how I feel about it. We begin to see the railroads who now have been, for coming up on a decade and a half, have been reaping the benefits of deregulation and have been taking advantage of the fact that capacity and demand for rail freight have crossed and have begun to adopt an approach in which they would not describe it this way, but I will describe it this way. The approach is essentially raising price and cutting service. And essentially what that has done, it has made the Class 1 railroads wildly profitable, but it has crimped demand for rail freight. And so normally, as railcar investors, we would expect the demand for railcars to grow roughly with the economy. But now we're facing the hangover from the crude boom and a carload freight market that has essentially stopped growing. And so those two things combine to make the 2015-2019 period a very challenging period. And when I'm going to get into some slides later that illustrate mathematically exactly how challenging that period was. And again, I talked earlier about cheap liquidity. Again, interest rates are not yet at their lowest point here, but they're quite low. And there are a lot of investors pouring into the railcar market, despite the fact that these are the hangover years that are exacerbating the problem of excess supply relative to demand. All right, so I'm almost done with the history lesson, and then we're going to briefly get into the market, and then I'm sure there's Q&A. So the most recent period of history has been, as I say on the slide, a wild ride. First of all, COVID was remarkable in the sense that carloads evaporated and then came roaring back. And they evaporated and came roaring back in an incredibly short period of time. I can remember I had intermodal cars expiring with a Class 1 railroad. In order to prevent that railroad from returning the cars to me, I discounted them to a rate that was 1/3 the previous market rate. And even then, it was a tough negotiation. I was forced, and I hate doing this, I gave them a 1-year lease with a 1-year renewal option. And the 1-year renewal option was priced at the midpoint between that deeply discounted rate and the full market rate. They wanted a renewal at the deeply discounted rate, which I absolutely refused to give them. A year later, that midpoint rate, that 1-year renewal, was completely in the money. The market rate for those cars had roared back past the previous market rate and was now higher than it had been pre-COVID. And that's all in the space of a year. So gives you an idea of just how dramatically the market bounced back. At the same time, we begin to see this incredible round of inflation that we've never seen. Or at least I shouldn't say never seen, that we've not seen certainly in the 27 years I've been in the business. So we see new car prices come roaring back. And I'll give you a data point here. At the bottom of COVID, I bought 200 60-foot high-capacity boxcars. I bought them because the price was so low I couldn't pass them up, and I should have bought 2,000 instead of 200. But I bought 200 of these cars for less than $110,000 a car. And I see the look on Harry's face. That car, once inflation had finished wreaking havoc, peaked at around $165,000. So think about that. Over the course of basically 2 years, to go from less than $110,000 to around $165,000 for the exact same asset. And that just tells you the incredible impact of inflation over a very, very short period of time. You also, though, in addition to inflation, you start to ask the question during this period, at any price, can we get people to come and build rail cars? And that is going to become, it is and is going to remain a very fundamental governor on new car production. And so that last question, and this is what I'm going to spend the next couple slides on here, is this the new normal? All right, so with that, we've gone on our trip through history, and I want to make sure I'm good. All right, I'm going to give myself 10 minutes to go through current conditions, and then we can get to Q&A here. So I talked earlier about the effects of PSR. This chart is a little busy, but bear with me. I'm going to talk about really what the modern carload market looks like. A lot of you in here know Eric Starks of FTR Associates. They're one of the, I think, best forecasting firms in the industry. Eric Starks is a good friend of mine. He's the chair of FTR, and he always asks the question, why do you need a rail car? To move freight. So I always quote Eric when I talk about carloads, because as a car owner and a car investor, I need to care about carloads because otherwise there's no reason for me to do what I do. This chart is the way GATX looks at the carload market. And basically what we do is the bottom 4 lines are commodities whose carloads are going to fluctuate for reasons that have nothing to do with the fundamental health of the rail car market. So coal is the sort of beige line, and coal is in secular decline. We all know this for reasons that have nothing to do with the fundamental health of the rail market. Then you have sandstone and other dense minerals, and really I put that down there because frac sand obviously had a rise and then a fall, but also in here is aggregates, which is very seasonal and again driven by construction, not really driven by railroad fundamentals. You've got grain, which again is driven by a wide range of factors that don't relate to the fundamental health of the rail car market. And then finally, petroleum products. And again, we talked about crude by rail and the tremendous rise and fall of crude by rail. So again, we want to exclude those commodities. Not that they're not important, they're incredibly important. But when we think about the fundamental health of carload demand in North America, we want to exclude those commodities and look at that blue line up top, which is everything that's not in the 4 lines below. And by the way, this excludes intermodal, so I'm talking about carloads here. So at GATX, we refer to that blue line at the top as core carloads, and we look at that as the measure of the fundamental health of the North American railcar market. What you can see here is that is a very, very range-bound series of data. You have at the left-hand side the dip in the Great Recession, which was quite severe. Near the right, you have the COVID dip, and you can see just how brief the COVID dip was. Other than that, you are basically in this roughly flat range-bound situation. Now, you may ask yourself, well, wait a minute. Isn't the American economy growing? Isn't freight growing? Why wouldn't core carloads be growing? And I come back to so-called PSR. At the end of the day, the North American rail car market is structured in a way, and the North American rail market, I should say, is structured in a way that the railroads are emphasizing margin over volume. And as a result of that, what we see is core carloads being flat. And in my opinion, for as long as the industry is structured the way it is, you're going to continue to see this flatness. The opportunity for carload growth is going to be very, very limited. So I talked earlier about the backlog of ordered but unbuilt rail cars. This is just a visual description of what I was talking about. You can see in 2014, 2015, that extreme peak that I talked about. I bring this chart up just again because we're talking about the current state of the market. This underscores how cyclical the market has been. But if you look at the right-hand side, you may note that it appears to perhaps be becoming a little bit less cyclical. Hold that thought. We're going to be talking about whether, in fact, there is a fundamental change happening. So I'm not here to talk about how GATX is performing financially. But we publish data, and because we're one of the few pure play railcar investors that's a public company, a lot of people in the industry look at the data we publish as a proxy for how the railcar market is doing. So this is all public data. I'm not sharing any deep secrets here with you. And what you can see here, the bars are the length of the lease terms we're writing on average, and the line is the percentage change in lease rate from the expiring rate. Now, one thing, when you look at the orange line, you can see that I told you the builders are cyclical. You can see that the lessors also operate in a very, very cyclical market. When things are bad, we're seeing substantial negative price changes. When things are good, we're seeing substantial positive price changes. But I bring this up because we're going to be talking about the current market and whether things may be fundamentally different in the current market. And what I'll start by saying here is you can see 2022, 2023, and 2024 on the right, we are in, relative to history, a pretty strong railcar market. Prices are rising, terms are relatively long. So it's a good railcar market right now. But I will tell you, it's a different railcar market than, say, the last time we had a strong market from 2012 to 2015. And I'm going to go into a little bit about why. So here's some more data. And this just compares GATX's lease price index. That's the line you saw on the previous page. And that is, again, the change in the renewal rate versus the expiring rate for GATX's fleet. This compares that to the industry backlog, which I showed you 2 slides ago. And so what you can see is up until COVID, there was a pretty good correlation between lease pricing and industry backlog. Look on the right side, maybe not so much. You might ask yourself, what's going on? All right, I'm going to answer that question, but bear with me. Another thing we see here, we like to look at the net change in the fleet. So the blue bars going up are cars added to the North American fleet. The orange bar is going down, are cars leaving the North American fleet. And the light blue line is net fleet change. And so what you can see here is, again, I talked about how cyclical and how volatile the market is. You see some tremendous dips in the light blue line. You see some significant peaks. On the right-hand side again, you might ask yourself whether you're detecting a trend of moderation there. And I would argue, and we'll get into this, that perhaps we are. No, this is all rail cars in North America. Yes, everything I'm talking about, unless otherwise stated, is all rail cars in North America. Including intermodal, yes. This is literally every freight carrying asset with an even number of steel wheels in North America.
How would that likely work?
Oh, on the from a carload standpoint. So in other words, if carloads were growing, how would this look? Oh, I see what you're saying. Yes. What I would say is that in general, core carloads are a large enough share of the overall fleet that this data roughly tracks core carloads. There's not enough difference where if I were to say take out grain cars, coal cars, intermodal cars, petroleum tanks, this would look a lot different. It would probably be the extreme highs and extreme lows would be less. The overall trend would be similar, though. Good question. All right, so here's another juxtaposition of data. So this is GATX's lease price index, which again, we're using as a proxy for the market here, relative to net fleet change. And again here, a little bit less divergence perhaps than we saw with the previous slide, but there is some divergence here, and the divergence here seems to emerge after the crude boom. So pricing craters after the crude boom, but net fleet change stays high. So why might this be the case? Well, I mentioned cheap interest rates and money flowing into the railcar market, despite the fact that demand didn't support that investment. All right, so at GATX, if you've listened to our earnings call, we are calling the current market a supply-led market. And so what that means essentially is that the previous tight railcar markets were driven by demand, whether it was center beams for lumber or coal or ethanol or frac sand or crude oil. There's no demand catalyst. I showed you the carload data. There's nothing exciting from a carload demand standpoint, and yet the railcar market is tight. So we got to talk about why. Well, first of all, I talked earlier about inflation. There's three things you need to make a rail car: steel, money, and labor. Now, there's a lot more stuff, but these are the basic elements here. Plate steel has come down, but if you look over the last decade, still a CAGR of almost 3%, certainly well above the Fed's 2% inflation target. The 10-year Treasury cumulatively over this time is up over 100 basis points, so the cost of money is higher. Cost of labor has a CAGR of almost 4%. We use the AAR labor rate as a proxy just because it's public, but I can tell you that other labor costs within the industry on a relative basis have had a very similar level of increase. And so what this means is the cost to build a rail car and the cost to finance a rail car are really high. So we can see when we look at the data for backlog deliveries and net orders, how different 2024 is from past tight railcar markets. So the 2024 railcar market, make no mistake, is a tight market. And we can compare the tightness in terms of fleet utilization to the peak of the crude boom or the peak of the ethanol boom, so 2014 and 2006 here. And yet, the backlog is much smaller, annualized deliveries are much smaller, and annualized orders are positively tiny. So something different is happening in this tight railcar market than has happened in previous tight railcar markets. And again, it's because the tightness is supply-led, not demand-led. All right, so what does that mean? Well, we think at GATX that a tight fleet may be the new normal. And what that means essentially is in the past, we would see production overshoot demand for new cars, and then you would see a collapse in lease pricing and a collapse in fleet utilization. We don't see that happening right now because the industry is not overshooting. And we don't see the industry reverting to past form and building over 80,000 cars a year because cars cost too much to manufacture. They cost too much to finance. And as I mentioned earlier, labor at any price is extremely difficult to get. So we think that the North American railcar manufacturing ecosystem is going to cap out at less than 50,000 cars a year, barring some external force that drives more production. And what that means is we're also calling this not just a supply-led market, we're calling this a self-correcting market. And what that means is any market that gets a little bit of oversupply, any railcar market, because remember, there's no such thing as an overall railcar market. There's a boxcar market, there's a small cube hopper car market, et cetera, et cetera. Any individual railcar market that gets a little bit oversupplied, we're going to see scrapping of older cars take out that excess supply, and the fleet will rebalance really quickly. In contrast, just to pick on frac sand as an example of a market that was not self-correcting, when the frac sand market was booming back in the middle of the teens, we saw what used to be a 50,000 car market turn into a 120,000 car fleet, and demand reverted back down to about 70,000 cars. There's no way that fleet can be self-correcting. If you've got 40,000 or 50,000 brand new rail cars that are surplus to requirements, that is going to take a long time to work its way through the system. We don't have any dynamics like that today in the system, which is why we think this market is going to be more self-correcting. The oversupply that we saw in the frac sand market, the crude market, the ethanol market, that oversupply just isn't occurring. So the interesting thing about this dynamic is traffic actually recovered coming out of the last several recessions because of those cheap oversupplied rail cars. Those actually were a catalyst for traffic to move onto rail. I'll give you a great example. When the frac sand bubble popped, a frac sand car is also a cement car. We saw cement shippers take advantage of the availability of cheap surplus frac sand cars and actually convert truckloads to rail. Cement is a modally competitive commodity where it moves fairly short distances, and there actually are conversion opportunities from highway to rail. So here, we don't see the availability of these young, high-value fleets that can actually act as catalysts for modal conversion. And so we don't see the boost, therefore, coming out of those oversupply periods that can actually help grow rail traffic. And so this is illustrated here again. I'm back to railcar data here, and I promise I'm almost done for those of you who have questions. This is the same data I showed before for builds, but now we're doing it not in the absolute, but builds relative to replacement. And we're using 35,000 cars a year as the replacement level. Here, you can see in the peak of the crude boom, the industry built over 47,000 cars more than the replacement level in a single year. In the current world, we're going to peak at maybe 9,000 cars more than replacement. In a tight rail car market, that is a historically low level of excess production. And this is the last one of these slides I'm going to put up here. Now we do builds above replacement relative to pricing. And here I think is where the potential divergence that we're seeing looks most acute. Pricing and builds relative to replacement are clearly diverging, and they've been diverging basically since the COVID recovery began. Something different is happening in the railcar market than has happened historically, and I believe it comes from the fact that, again, it is now very expensive to build and finance a railcar, and even if you can, the labor is hard to get. So the railcar market is fundamentally adjusting, and I'll also add, it makes sense that if the carload market, if carload demand isn't growing and you're a car builder, why would you size your build footprint to build 80,000 cars a year? Why wouldn't you size the build footprint to be a little bit more than replacement if we're going to be in essentially a flat demand environment? And I would submit that in addition to all of the inflationary and interest rate factors that I've just described, the car builders are being rational and saying, we're not going to size to build 2.5 times replacement if in fact we're looking at a replacement level demand market from a carload standpoint. In addition to all of that, one of the reasons I really believe in the self-correcting fleet theory is there are still a large number of low capacity bulk rail cars that are quite elderly that are very good scrap candidates. So if we do see a brief period of oversupply in the market, all you're going to see is this large portion of cars shown here on this page. You're going to see that the scrap rates accelerate on these cars. So this, to me, if you question my thesis about this being a self-correcting railcar market, this is the data I think that makes that thesis almost irrefutable, and one reason why we feel fairly confident in the relative stability of the railcar market going forward. So talking about the future, again, to recap, the fleet is really not growing, and again, given carload demand, probably shouldn't be growing. We do think the scrap environment is going to continue to be accommodative to the extent any oversupply emerges. And again, we think new cars are going to continue to be very challenging to build and finance. And all of that speaks to the fact that we don't think we're going back to the boom bust times. We think we are in a more stable future for rail cars, and we think new car production is going to be approximately equal to or perhaps slightly higher than the replacement rate. With all that, we got through it. So I think Brett told me to be about 45 minutes, and I think I was just about 45 minutes. So I feel pretty good about that. I would be delighted to go down any rabbit holes anyone would like. So I'm happy to entertain questions. Harry? It's interesting, and what I will tell you is I believe it's financing costs. You know, if you think about, I did some crude math, and I'll go back to my 60-foot boxcar example. So I did some crude math, and if you bought that very cheap 60-foot boxcar that I was describing at the bottom of the COVID dip, and you financed it with, you know, a sort of at a market interest rate at that point, the monthly interest burden that first month you own that car would be about $250. And you know enough about boxcar lease rates. It's really easy to cover a $250 interest payment with whatever you can earn on a 60-foot boxcar. Even at the bottom of COVID, you can make enough on a 60-foot boxcar that you can make a $250 interest payment. The combination of higher car costs and higher interest rates, and frankly, higher interest rates are the much bigger factor in this, means that a typical buyer of that same boxcar is going to have probably about $800 of monthly interest cost in month one of owning that boxcar. The revenue available on that boxcar is in some cases less than $800. And so financing costs are really a barrier to people rushing into the market and taking speculative or aggressive positions. So I do think there may be some people entering the market, but I will say that you have to take a long view and you have to be very educated to make a bet like that, versus if your monthly interest nut is 250, you really don't need to be that sophisticated to make that bet. That's a bet that less informed investors can make pretty easily.
Let me hand over a mic so the people remotely can hear you.
What do you see? What do you see as the major changes in the labor market? Are we missing the classic Ford assembly line hammer bangers who banged hammers 8 hours a day? Are we missing those people, or does the rail car construction industry need more technically competent people, like the factory floor in John Deere and Waterloo, where it's no touch. You've got people working CAD CAM, and they probably have no more than a high school education and a little technical background. Where is the labor market shifting, and what are you seeing as far as getting competent labor, available labor, let alone competent, to build freight cars?
It's a great question. I'm going to give you a slightly long answer to that. So at GATX, we are not a car builder, but we employ a lot of people repairing and maintaining rail cars, and actually a lot of the skills are very similar. Our repair activities are all in the US and Canada, and for the most part, we have union labor that makes good wages with good benefits. And for the most part, we did not furlough anybody during COVID. I think we furloughed 6 people during COVID. So we largely kept our workforce intact. And what that means is we've been able to hold on to our workers and keep them employed, which has been great. But I can tell you my experience, we've been adding shifts because we're trying to insource more and more of our repair right now. And my experience hiring workers to add shifts at our facilities has been extremely difficult. And there, what I will say is, I think it's a combination of different things. I think number one, the labor market is just very, very tight, so people have their pick of jobs. I will also say, and I want to say this too, I am not one of those people who sits here and says, young people don't want to work today. That's ridiculous. I believe in the supply and demand of labor, and people should work for a wage they feel gives them a fair reward for what they do. So this is not me griping about workers at all. In fact, I'm very pro worker, for those who know me. But I will say, I think workers, number one, have learned to value their time a lot more. I think the trade-off, I think pre-COVID, a lot more workers were willing to say, I'm willing to have a bad lifestyle in order to put food on my table. And I think that a lot of people have just said, no, I'm not, I will find other ways to scrape by. I'm not willing to have a bad lifestyle. I think a lot of workers are also saying, I want to work in a job where I can be physically comfortable. I'll give you an example of this. I've been investing in automated cleaning racks in our repair facilities to try to reduce or eliminate the number of times humans have to enter a tank car, because entering a tank car is the worst job in a repair facility, not just from a safety standpoint, but just from a comfort standpoint. It's hard to hire people who want to work inside of a tank car. So what do? You automate that job away. You make it easier to acquire people to work for you because the conditions of work are better physically. So I do think that COVID caused people to reevaluate how they want to spend their time, whether they want their lives disrupted, and whether they're willing to tolerate physical discomfort in their jobs. And I think, and I actually will say, I kind of commend people for this. People are saying, no mas, I don't want to do that. I want a better life. And better life isn't just better wages. It's not doing jobs I don't like at hours I don't want in locations I don't want. And I think there's a lot more of that. So employers are forced to both pay more in the cash wage sense, but also pay more in the sense of making jobs more attractive. And all of that adds to the cost of producing whatever the thing is that you're producing. Now, let me turn to the car builders, because I'm speaking as a rail car repair provider, not a car builder. So the car builders are all migrating to Mexico because, like so many manufactured goods, you have to go where the labor is cheapest. And the labor cost advantage in Mexico is quite substantial. If car building occurred north of the border, that $165,000 boxcar probably is a $200,000 boxcar today. And it's already, frankly, not economical at 165. So you go to Mexico, you do have lower labor costs there. But one of the interesting things with nearshoring is there is now tremendous competition for labor in Mexico. And so The rail car builders are not the only manufacturers that are going south of the border. And so they risk eliminating the very labor advantage they fought to get by moving to Mexico if they bid up the cost of labor. And so at a price point where they can still sell 45,000 rail cars a year, I think the builders have basically maxed out the supply of labor in the parts of Mexico where they operate right now. And I think that phenomenon, given everything we're seeing in terms of investment in manufacturing in Mexico, that phenomenon is probably not going to change anytime soon.
You got a couple, Paul. Well, this is a strange one. Walk us through the economics of scrapping rail cars.
Okay. So what we and what most car owners do is so first of all, the economics of rail car leasing are at their core incredibly simple. We are discounted cash flow people, right? So we've got our after-tax discounted cash flow model, discounted WACC, and the scrap decision is a subset of that decision-making process. And what you're basically saying is, I've got a car in shop. It's an elderly car. And I have two choices. I can dispose of the car, and it's going to cost me some money to clean it. It's going to cost me some money to ship it to the scrapper. And then offsetting that will be the proceeds that I get. So on the one hand, that's my net scrap proceeds over here. On the other hand, I can spend money to repair the car, keep it in service, and get a bunch of future lease payments, and then eventually get future scrap proceeds. And all I'm doing is comparing the NPV of A versus B. And it's essentially that simple. And so obviously, for a 10-year-old car, that repair bill has to be huge for me to want to scrap it, because the pile of future rent associated with that 10-year-old car is enormous. But for a 40-year-old car, particularly because you can't necessarily bet you're going to get the full 50 years of regulatory life out of that car, for that 40-year-old car, you better be really confident about the rental stream you've got, or else you're probably going to make that scrap decision. Because remember, the scrap proceeds are a bird in the hand. The future lease proceeds are, in many cases, speculative. You may not have contractual visibility into all those future lease proceeds. For scrap right now, net of transportation costs, I'm going to give you a wide range because there are a lot of variables there. But a 40-year-old boxcar today, you could scrap for $5,000 to $10,000. True.
Along those same lines, is there internal pressure at the point at which you have a scrap candidate that you have to take some type of book write-down? Does that become unpopular on some level of your business?
So I am really grateful to work for a company owned by very patient investors. So GATX, we're public. We actually have one of the longest unbroken dividend streaks of any company on the New York Stock Exchange, which we're very proud of. If we mess that up, there'll be a different person giving this lecture next time. But we have very patient investors. Roughly 80% of our shares are owned by 10 companies, and many of them have been with us for decades. State Farm is our largest shareholder. They've been with us since 1982. They own over 15% of our stock. I bring this up as a way of answering the question. A lot of people who work at public companies are not so fortunate. They have investors who are incredibly focused on the next quarter. And don't get me wrong, our investors care about the next quarter, but in general, we are free to make the best economic decision without regard for the accounting consequences. And we do. That's how we run the business. Accounting for us is an output, not an input. So now the good news is, for the most part, the way we manage our business, it's pretty rare that a scrap decision results in a book loss. The accounting lives we assign to our assets generally match up pretty well with the economic useful lives. So I can just tell you the vast majority of scrap decisions we make result in either book neutral or book positive results.
So, Paul, I have to just sort of the innate contrarian in me has to ask the question. And so you draw this picture that sort of outlines, well, the past was very troubled, but the future is just fine. I mean, is there something, obviously you wouldn't identify or you don't know of a black swan that's out there, but doesn't that sound maybe a little too convenient?
Well, it's a great point, Harry. And what I'll say there is this. I'm actually
Mhm.
I'm an optimist about the rail car market, which is different from being an optimist about the rail industry. So I would say I'm decidedly neutral about the rail industry. I talked about carload demand. I think we are locked into a sort of flat carload situation in the railroad industry in North America for the foreseeable future. And I wish that were not the case. You know, we're for all the reasons I talked about, the economic incentives for the railroads, who, by the way, do not have patient shareholders. In fact, quite the opposite. The economic incentives are to maximize operating margin and to do that often without regard for carload growth. So I would say, I guess I would say I'm not a blind optimist at all. I see the industry for what it is. I think, however, with respect to the rail car market, there are simply dynamics at play right now. You know, again, I've been in the industry for 27 years. There are dynamics at play that are different than anything I've seen in my 27 years, and I think before that as well. I may be wrong, first of all, and it may also may be that, to your point, there may be a black swan event that I haven't forecast that could change the dynamics. So I guess maybe what I'll do is I'll caveat my prediction here. I think that if the macro fundamentals stay the same for the rail market, and we don't see some dramatic change in, let's say, for example, deflation of labor or deflation of steel, or some dramatic cutting of interest rates, or something that I'm not contemplating here, I think if you see that, then all bets are off. You know, and we could be right back to a very different circumstance. So, but what I would say is, given the fundamentals that I see right now, I think the right conclusion is this more stable market.
Thank you, Paul. And you may have addressed this before I came in. If so, I apologize. I think I know what you're suggesting about when you said that at this point, conditions in the rail industry are not going to result in growth in carloads. But could you elaborate on that a little bit, on how you see it?
Sure. You know, what I will say is this: I am not a railroader. I'm a rail car guy. So, and I don't pretend to be one. But you know, one thing we know is that the investors who invest in railroads today have, rightly or wrongly, fixated on the idea of operating margin, operating ratio. One is the inverse of the other, so you can take either one, as an indication of the health of the carrier. And the kind of rail traffic that supports the kind of operating margins that Wall Street demands of the railroads, that traffic exists. That's the carload graph that I showed you produces those operating margins. The kind of traffic that doesn't ride the rails today doesn't produce those operating margins. And now it may, and I actually suspect it does, produce excellent long-term ROIC, return on invested capital. And I think if you could talk the investors in railroads off of operating margin or operating ratio as their core metric, and could actually get them to say, I'm going to chase good economic business that might be dilutive to my operating ratio, they actually would produce a better long-term result for their shareholders. In fact, I feel fairly confident that's true. But as long as the be-all, end-all metric, and despite the fact that the class ones will all tell you it's not the be-all, end-all metric, we all know it is, you're just not going to capture traffic. And the reason for that is this: the competition is the truck, and the truck provides a high-touch experience for shippers. And it is expensive to provide a high-touch experience for a shipper. If you want to convert truckloads to carloads, you are going to incur operating expense in order to do that. And therefore, you are going to dilute your operating ratio or your operating margin. Again, this is, in all likelihood, a lot of this business is economically accretive, but it is dilutive to operating ratio. And until we address that issue and say we don't need to care about maintaining a 59 OR or whatever today's metric is, we're not going to grow. You know, for a long time, the AAR touted, look at our CapEx, look at our CapEx, we're committed, we're committed, we're committed. And my response is, show me your OpEx. I will believe you're committed to growth when I see OpEx. That's, I would say, what we're not seeing. I mean, I don't. I mean, I will say that, again, I'm not a railroader. I'm as a former boss of mine used to say, I'm a humble railcar peddler. You know, the investors in the class ones have their point of view about what they want. And at the end of the day, the executives who work at the class ones are there to meet the needs of their investors. And I honestly can't fault them for that. You know, Wall Street has decided it cares about operating ratio. The people who run the class ones have said, okay, Wall Street, we work for you, you pay our salaries, we're going to deliver operating ratio. And they're doing that. And so, you know, in a way, it's not for me to be critical of that, because that's the way capitalism works. Your shareholders buy your stock, they get board seats, they tell management what to do, management does it, and that's what's happening. Something would, you know, one of two things would have to happen. Either externally, something would have to tell the railroads you have to behave in a different way. And, you know, Staggers obviously gave rise to this. PSR would not be viable under the ICC. So Staggers gave rise to the environment that allows this. So something external like that, or a change in the thought process of Wall Street that de-emphasizes OR and emphasizes ROIC.
We have one last question. And my question is somewhat two-pronged. You haven't really, except in the answer to the last one, talked much about service. And so as a part of length of haul, I haven't really heard you say how much the market has changed in that respect. The other, having worked for a leasing company but in the container world, the fewer bigger customers, especially with rail holding companies, impacting that demand side, if you will. I'm curious what you see for the future, both on the rail leasing company as well as the rail operator.
So I'll start with length of haul, and really that's just kind of a subset of the modal share discussion. You know, in my mind, the traffic that moves by rail today that generates these very low operating ratios is generally long haul, non-service sensitive bulk traffic, with the exception of intermodal. Intermodal and automotive, which are the two, you know, so-called premium services, they are their own separate thing. But outside of those, it's non-service sensitive long haul bulk. And you know, that's ultimately, again, that if the priority is maximizing operating margin, minimizing operating ratio, that's the traffic that will do that. And so the network, this long haul bulk network, looks like the network that would be described by investors who want to maximize operating margin. And so anything short haul is definitionally higher touch and therefore lower operating margin. I'm not sure I understand the second part of your question. Perhaps you could restate or repeat.
Yeah.
Check. To elaborate, there are, to my estimate or my sense of the market, fewer clients with railroad holding companies with fewer short lines, or short lines that are now brethren. How does that impact some of your capital investment decision making for replacement or negotiations, and of course replacement level build?
Well, what I'll say there is, so, you know, obviously this is an industry where we deal with lots of very large customers. So in our business, you can think of it sort of as a 75-25 or 80-20 rule, where 75 to 80% of our customers are rail shippers and 20 to 25% are railroads. And of the railroads, we have customers that are class one railroads, we have customers that are short lines and regionals, and of the short lines and regionals, we deal with the large short line holding companies as well as independent short lines and regionals. So,
but even the chemical companies are increasingly merging and acquiring, and the cement companies and on down the list. Fewer customers, I guess, is a part of what underpins my question.
Fewer larger customers. So what I'll say is at GATX, we have over 800 unique customers in North America. And they range in size from literally customers that might lease one rail car from us. That's pretty unusual, but they do exist. All the way up to, Dow Chemical and giants like that. And what I would say is we try to provide value. We try to meet those companies where they are. And what I mean by that is, we can provide value for that very small rail shipper who has a tiny fleet and can provide a very high touch service offering and make money doing that. We can also go to Dow Chemical where it's going to be a completely different negotiation. And we can earn a return doing that. You have to understand as the lessor, though, what your value proposition is in each of those situations and everything in between. And you have to price and structure your lease offering in a different way. Broadly speaking, though, what I will say is, as an operating lessor, one of the secret weapons we have, and I think this is really key, is anybody can buy a rail car, and lots of people that have a balance sheet can buy a rail car and provide the capital. A lot fewer people understand how to maintain and manage and remarket those rail cars, and fewer still own a shop network like we have that can maintain them. And so for us, people who don't know our business will look at us and say, we're a BBB rated company, so we're investment grade, but we're not a high investment grade. I lease cars to customers that have a higher credit rating and a lower cost of borrowing than we do. So, people who are financially sophisticated will say, well, how can you as a BBB make money leasing to a AA? And I can say, because that AA isn't paying me for my credit rating. They're paying me for my remarketing expertise. They're paying me for my repair shops. So, essentially, it's all about, how are you making money? And for us, it's the value add that allows us to do that, whether it's with a giant customer there's a lot of leverage over us, or whether it's with a mom and pop or anybody in between.
Paul, thank you very much. For a guy that spent a few years with a car builder as a client, this was absolutely fascinating, and you nailed it.
Well, thank you. Thank you. It's been my pleasure.
Thank you. Our next meeting, give me the date, please, December 16, will be with the one and only Tony Hatch. We will be downtown, and we will have the announcement out here pretty shortly. It's our usual holiday financial focus meeting, and I hope all of you would be interested in coming, and we'll see you then. If not, well, in the meantime, happy Thanksgiving, happy Halloween, and hope we will see you in December.